All right. Are you ready to do this again, Chris?
We are back. Looking forward to it. Let's get started.
Okay, why don't you start with question 1 this time?
Okay, now are we doing specifically in financing or are we just doing random questions today?
I think today let's just do all finance.
All finance. Okay, here we go. Here's question number 1. What does the term hypothecation refer to in mortgage financing?
Is it A, the transfer of property ownership to the lender? Is it B, the borrower's promise to repay the borrowed funds? Is it C, the process of securing a loan by pledging property without giving up ownership? Or is it D, the evaluation of a borrower's credit worthiness? So, Chris, you know how we like to do. Is there one that you could eliminate off the bat?
As I'm looking at these, I'm going to go ahead and start at the top. And I see the transfer of property ownership to the lender. And in my mind, I actually know that that's the deed of trust.
Yeah, the trust deed.
Yeah.
That's what transfers ownership from the new owner to the trustee.
That's right.
So that's not going to be our answer.
I'm taking that one away.
Okay. And what do you think about B?
The borrower's promise to repay the borrowed funds is a great option because the test knows that you're going to be tempted for this, but that sounds more like a promissory note to me.
Yeah, that's so many times we get questions that say, what is a promissory note? And the answer is a promise to repay the loan. But in this case, that's the wrong answer. It's the right answer for another question, but not this question.
Well put, yeah.
All right, so now we're down to the process of securing a loan by pledging property without giving up ownership or the evaluation of a borrower's creditworthiness. So which would you go with?
I would go with the answer on this is C. You have given up the property as collateral for a debt, but you're allowed to live in the property, which is exactly what happens in the mortgage.
All right, let's take a look. And it is, there we go, there it is, it's C. That is our final answer. We got one right.
All right,
Yay.
We're 1 for 1, and notice the wrong answers on this, guys. We're trying to hook you in to other answers.
Yes, because they're things that you would have seen before,
Yep.
But it's the wrong answer to this question, the right answer to another one. Don't fall for it. All right, I'll do number 2.
Okay.
What is a promissory note? Well, seeing how we just had that last question, this should be easy. However, this could happen on the real test too, couldn't it?
It absolutely could.
And if it does happen and you realize you answered something incorrectly, go back and change that answer. But, I mean, it could just be something that confirms that you chose the right answer as well. So what are my options? What is a promissory note? Is it A, a legal document that secures the property as collateral? Is it B, a negotiable instrument promising to repay a borrowed amount? Is it C, another name for a trust deed? Or is it D, a legal document that protects a lender from financial losses? Now, again, given that we just had our last question, I think we both know the answer is B. But let's talk about A, C, and D. They're the wrong answer, but what can we learn from them?
Well, again, the temptation here is to, you see the promissory note, and every once in a while you just have to dumb things down a little bit. The promissory note is simply the promise to repay. So I immediately jumped to B, and then, of course, canceled out the other ones. It has nothing to do with the security of the property as collateral. There is another instrument for that. It's just not this one, and I'm going to go ahead and take D out as well. A legal document that protects a lender from financial loss. You know what's tempting about that? I mean, that's why we sign notes, is so that the lender will be covered in the event we don't pay. But nothing guarantees that they're going to be able to get their money back.
It doesn't protect them from anything.
That's correct, yeah.
And what I love is you did say that the answer is B, as we know, promising to repay the borrowed amount, but it uses a word that we don't see a lot that might scare people off, negotiable. And we know to be negotiable, we're not talking about negotiating the interest rate. We're talking about the instrument, the actual note itself, the promissory note. It can be used like cash. And I like to compare that to like a poker chip. If you're walking down the streets of Las Vegas and you find a $5,000 poker chip, you can go trade that in for cash. And in theory, you could use a promissory note in that same manner. So that's what negotiable means. If you know your vocabulary, then that word doesn't scare you. But if you don't know your vocabulary, it might scare you to think, oh, that's not the right answer. But now you know it is.
Yep, great point. I love your example that you gave.
Oh, thank you. Just because you like Vegas. All right, let's do number 3. This is all you.
All right, in a lien theory state, who holds the title to the mortgage property? Is it A, the mortgagee, B, the mortgagor, A trustee, or D, the beneficiary?
That's a lot of people.
Yes, it is, but every one of them is a very important word. Tell them why.
Okay, so we know that we use this word, the term, I'm going to go to the bank and get a mortgage. We use it wrong all the time. When in fact, the person who wants money is going to the bank to receive cash. In exchange for that money, you're giving the bank a promise to repay the loan, our promissory note, and then you're giving them another document that says, hey bank, you can sell my house if I don't pay you back. It's a document that makes the house collateral or security for the loan. So we use words incorrectly all the time. And I think that's really important to understand because when you look at the words mortgagor and mortgagee, they're backwards from what you would think. We know OR is the giver and the EE is the receiver. So based on what I just explained, the mortgagor is actually the borrower because the borrower is the one that is going to the bank to get money, and in exchange, they're giving that promissory note and they're giving an actual mortgage, the collateral document. So the mortgagor is the person giving the mortgage. The mortgagee is the person receiving the mortgage. Now, in this particular question, it says a lien theory state, which means it's a state where that mortgage document just says, hey, bank, this is my house, but I'm promising to repay you. And if I don't, you can foreclose by putting a lien on my home. I'm going to keep ownership, but you're putting a lien on my house. And then if I foreclose, you're going to have to go through the courts and the courts will force a sale. So that is really important to the understanding this question. In a lien theory state, who holds the title to the mortgage property? Well, is it the mortgagee, who would be the lender, or the mortgagor, who would be the borrower? A trustee and the beneficiary, those are answers that would be involved if this was a title theory state. So I'm going to eliminate C and D. I got to figure out who holds the title in a lien theory state, and I know our answer is B, the mortgagor, the borrower. They're holding on to title, and the lender is the mortgagee. All they're getting is a lien on the property.
I didn't want to break your flow in there because it is so important to make sure that you understand that whole process. Would this have been a different answer if it had been a title theory state? Absolutely, it would have been a different answer. But notice Candace's process there in breaking it down. The buyer owns the property, and they're going to hold the property. It's just that the lender has a right to put a lien on it. So title is in the name of the mortgagor. Perfect.
I love it. All right, number 4. What is the primary purpose of a deed of trust in mortgage transactions?
Yeah, see, again, we're seeing a lot of the same things again. So I'm going to start on my pecking list on this, and I'm going to start with A, where it says to serve as evidence of the debt. There is a document that serves as the evidence of the debt, but it is not the deed of trust.
Otherwise known as a trust deed. We know that document is actually the promissory note. So we can eliminate A. What about B, to guarantee the loan amount? Does that sound about right to you?
Yeah, it looks interesting. That is one that could be a hook.
I mean, it sounds good, but guarantee the loan amount? Are we guaranteeing to me that I'm getting it or guaranteeing that the bank's going to get repaid? It's really vague. So if you aren't sure, you could leave it as a maybe, and I think that would be good.
Yeah, are you saying that the word guarantee, none of these instruments really guarantee that the bank is getting anything. They certainly are collateralization instruments, but they don't guarantee anything.
Where's the only place we see that guarantee when we're talking about finance? What is being guaranteed? Is it the VA loan with the certificate of eligibility maybe? Yeah, that's a guarantee. But everything else, like Chris just said, that's just how the bank is trying to make sure they get paid. But there's no guarantee unless it's a VA loan. All right, so I think we've eliminated B. What about C? To document the loan's interest rate.
Yeah, almost certainly that's going to be in the promissory note, but that's not the purpose of the deed of trust or trust deed.
Which leaves us with D, to convey title from the borrower to a trustee as security for the loan. And I know that D is our right answer. And I know, guys, it seems like we're saying the same thing over and over again, but here's the thing. We're saying it in different ways. And that's why we put this together this way, because if you only learn one definition, if you only know that a promissory is a promise to repay, and that's all you understand, you're going to lose out on some other questions. We want to have a full understanding of how it kind of goes together and how it all works, so that it doesn't matter how they come about the question, you can always get it right.
Yep, and I love playing the game that you all often talk about, the false, 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 true game. You get down to D and there's only one left. Hopefully you're going to recognize some words. It doesn't mean that it's automatically D. You may have to go back and reread the others, but that's a great way to know that I'm going to read D critically because I've ruled the others out.
Exactly. All right, let's try number 5. You go ahead and give this a read.
A point charged by lenders at the origination of a loan equates to, is it A, 1% of the loan amount, B, 1% of the purchase price, C, a fixed fee regardless of the loan amount, and D, 1% of the appraised value?
This one's a hard one because it sounds very similar. You got 1%, 1%, 1%. And sometimes when you take a test question, seeing that 1% option means it's definitely 1%. And sometimes they're just trying to throw you off. So we can't go by that. This is one of those questions, in my opinion, where it helps if you have something memorized, something that you know that you know. And what would you say that you know about points, Chris?
Well, as I look at those answers there, I know that the definition of a point is that it is 1% of the loan amount. So I already had that locked in almost with those exact words, which doesn't always happen, but that's the definition I have in my mind.
And that's why definitions and vocab is so important. If you know a point will always cost a borrower 1% of the loan amount, when you see it, you can go with it. It doesn't mean you shouldn't read the other answer choices, but you know that a point will cost you 1% of the loan amount. And you don't want to get fooled by B or D, where it's 1% of the purchase price. Nope, not the purchase price, the loan amount. D says 1% of the appraised value, not the appraised value, the loan amount. And that fixed fee regardless of the loan amount. I'm sure there are a lot of people that wish that was true if you have a higher priced house, but it is unfortunately not.
Well, the interesting thing about C is oftentimes when we're doing math in the class, we use the same loan amount over and over, and people start to think that that's the cost of a point. No, it's a coincidence that you're using the same loan
That's
amount.
true.
Yeah, so you have to be careful about getting into group.
Because a lot of times we'll have loans that are $250 or $350 or something like that. So if you keep seeing that amount over and over, you could make that assumption. Good point. All right, you ready to move to number 6?
I think so. I think we nailed that one.
Okay. The Equal Credit Opportunity Act, ECOA, prohibits lenders from, is it A, charging interest on loans? Is it B, discriminating against applicants based on age, race, or gender? Is it C, requiring a credit check? Or is it D, offering different loan terms based on a loan amount? All right, the Equal Credit Opportunity Act. So hopefully somebody knows what it is, but even if they don't know off the top of their heads, I think the title of the act, Equal Credit Opportunity, kind of gives you some hints. We're talking about equal credit for everybody, giving you the opportunity to at least get some credit, as far as if I can get it or you can get it, like we're all treated equally. So even knowing that little bit just from the words, I would say, okay, we could probably eliminate some answers, like A, charging interest on loans. Well, one, banks only make us loans because they're charging us interest.
True.
So there's not anything prohibiting the lender from charging us interest. And also, we're talking about credit. So I think we can eliminate A. How are you feeling about B, Chris?
B looks like it has the right words and the right concept. So I'm going to lock into B. and I'm going to try to eliminate just to make sure that I haven't read too quickly and made a mistake. And one of the mistakes that you can make is when something looks like it's the right answer. I get it. You want to jump on it, but verify and just make sure that it's not that it is. Excuse me. I want to go to C real quickly and use the same logic that Candace said. Requiring a credit check. The fact of the matter is that's part of what lenders do as well, and offering different loan terms based on different amounts. That has nothing to do with equality. That has to do with the fact that the loans are based on different terms. And there is another act out there that's closely associated with this.
Oh, I know.
Do you know what it is?
Well, are you talking about the Fair Housing Act because of the classes?
Well, yes, but also in regards to the credit, the Fair Credit Reporting Act, and then you've got the Equal Credit Opportunity Act, and then as Candace said, the Fair Housing Act. So it's not that there's not a hook here. Take it from there.
Well, I think for this one, where I think people might get scared is it says in B, age, race, and gender. And a lot of people will memorize what the Fair Housing Act says, which I like to use the acronym FRED's Corn. What's protected? Familial status, race, disability, both mental and physical, sex, color, religion, national origin. We all hear that all of the time. And it might be scary to say, oh, somebody's being protected based on their age or their gender like that, because sometimes we'll say sex instead of gender. But the truth is, with the ECOA, the Equal Credit Opportunity Act, age, race, and gender are all protected. And it's a good question to remember the details. I like to tell people the devil is in the details, and that is a detail. You are protected by age. Not if you're under 18, but they can't look at you and say, oh, you're 70, you're too old for a loan. That's against the law. So I like B too, and it turns out B is the answer.
Yeah, people listening may say something to the effect, oh, well, golly, if it was so obvious to start with, why can't I just jump there? You will have plenty of time on the test to be critical about these questions. So just be careful as we suggested.
Yeah. All right, 7 is all you, Chris.
Okay. A loan that requires periodic payments that will not fully amortize the loan over its term is known as A, a balloon loan, B, a fixed rate loan, C, an adjustable rate mortgage, D, a reverse mortgage.
All of these are really good vocab words, but only one of them is going to apply. So let's look at what this question says. It requires periodic payments that will not fully amortize the loan over its term. So I guess maybe the best way to handle this is, well, is that the definition of a balloon loan, A? And I know that is not the definition of a balloon loan. Well, it could be. I would say as I look at it, a balloon loan in and of itself, you're going to have periodic payments that will not fully amortize. Usually if you have a balloon loan, it means it wasn't fully amortized. And this kind of goes back to what Chris is saying. Is this the right answer? Is it not the right answer? It could possibly be the answer. I'm going to leave it alone and say maybe. Maybe it's the answer, maybe it's not. And it's okay when you go through these answer choices to say maybe. We go through and we eliminate what we can. So let's move on to B. How do you feel about B, Chris?
Well, a fixed rate loan is typically referred to as a fixed rate fully amortized loan. And so it kind of is opposite of what they're asking in the question here. So I would have eliminated B.
Okay, I agree. Then we have C, an adjustable rate mortgage. Now, what I know about an adjustable rate mortgage is that those in an adjustable rate mortgage, different than a fixed rate, that rate will change. It'll go higher, it'll go lower, but generally the starting rate in an adjustable rate mortgage or an ARM, if you keep it at that rate, you're not going to fully pay off all the principal and all the interest through the term of the loan. It's usually typically lower than what it would take to amortize, and then it changes, usually going up over time. So once again, I kind of like C. I'm not getting rid of C. I'm not getting rid of A yet. So I'm going to go through and say maybe. What do you think about D, Chris?
Well, when I think about D, I think of definitionally what it is and what it refers to. The reverse mortgage is typically a loan that's, first of all, it's going to be targeted seniors. And why seniors 63.
Kind of like you?
Yeah, kind of like me. I'm approaching it very, very quickly here. And the reason it's called a reverse mortgage is you take the equity in the home and you loan it over periods to the homeowner. In other words, the bank is paying the homeowner as opposed to the other way around. So I think of it as a characteristic of a loan. I don't think of it as the definition of what we're looking at here. At the end of a reverse mortgage, it's either going to be paid off or the one receiving the mortgage is going to pass, and then it'll be paid off with the sale of the house. So I think that's more of a definition of a style of a loan.
Well, I like what you said. You said that a reverse mortgage, kind of, you think of it more as a feature of the loan. And now we are down to two answers. A balloon loan, and C, an adjustable rate mortgage. I'm not actually quite sure which one I want to go with, but I would have said a balloon loan is one where it's not going to fully amortize over the term, but I would have said a balloon loan is more of a feature of it rather than what it actually is. But what do you think?
I got to be honest with you. I'm going to go with balloon loan on this one, and the reason for that is when you have an interest-only loan, for an example, the final it'll never amortize. And so what happens is you make a balloon payment to pay off that loan, so it'll never amortize by itself.
I like it, and if it is a balloon loan, it never fully amortized. Although, if it's an adjustable rate, eventually it will amortize, which is what I like as well.
Let me try this one on you real quick. I like your thought process in talking about the adjustable rate mortgage. You went through some mental gymnastics on that. I was taking a test not too long ago, and I would get it down to two answers. And what I would do is I'd start bringing in extra information that was not given. And so what I'd do is I'd confuse myself. Candace, notice how she did in her extrapolation on that. She went a little bit farther than what they gave in the question. And so I don't necessarily think it was needed, and that may have been part of the confusement.
I think you're absolutely right, because an adjustable rate doesn't mean it won't actually amortize at some point. But by definition, a balloon loan, it did not. It did not amortize, which is why you have that big lump sum at the end. So yeah, the more I think about it, I think we're going to go with A. Final choice, Bob?
I think that's what I'm sticking with.
All right, we're going with A. And it is balloon loan. Yay! Sound the alarms. And guys, don't do what I just did, which is I went all the way around to find an answer. And Chris said it exactly. I had to add extra stuff. Well, in this case or that case, that's not what the question asked. It just said, hey, what is a balloon loan? This is what happens. I had to add stuff to make C correct.
Yeah, and it's kind of like sometimes you read the questions, you're like, well, that's incomplete. There should be more. There should be more. Don't fight with the test. What's in front of you is all you have to work with. So
exactly.
At the end of the day, make your decision based on that.
And guys, do exactly what we just did. We got it down to 2, and we keep going through it. We don't add any extra information, and which is the answer that best satisfies the question without having to say but or if or in, if we add that. That's how we do it.
Perfect.
All right, let's go to 8. What is the primary role of the Federal National Mortgage Association, otherwise known as FNMA or Fannie Mae? Is it A, to insure loans? Is it B, to provide direct loans to borrowers? Is it C, to buy and sell mortgages in the secondary mortgage market? Or is it D, to act as a regulatory body for mortgage lenders? What do you have on this, Chris? Fannie Mae? What do you know?
First of all, there's a lot of words here, and I'm exhausted just reading the question. Okay, I don't like big words and acronyms and things like that. There's one thing I know about Fannie Mae, and I know that they do not make loans directly to the borrowers. So I'm going to take the easy way out, and I'm going to go ahead and eliminate B.
Look at him taking the easy answer out. Yeah. It is definitely not B. You cannot go get a Fannie Mae loan. I think students sometimes get it confused with FHA because they both start with F. But Fannie Mae does not make loans to borrowers. All right, so you have eliminated B. I'm going to eliminate D. To act as a regulatory body for mortgage lenders. No, that sounds more like some kind of government entity, not Fanny Mae. Act as a regulatory body. I would almost say that is
the Fed.
Yeah, thank you. I couldn't think of the words.
They
Federal
probably
Reserve.
have a longer name, but the Fed.
Federal Reserve. Couldn't think of the name for a second. So I'm going to eliminate D. Now it's to you to think about A or C.
So we have A and C left, and I'm skeptical about this insurance idea. It seems to resonate with me in this chapter, but I don't think it goes with Fannie Mae.
And I think you're right, because I just mentioned FHA. And isn't that the point of FHA loans? It's to provide insurance for the loans. So the F sounds familiar, but insurance, FHA, which makes our answer C, to buy and sell mortgages in the secondary mortgage market. And we got another one right.
You know, typically when I teach the class, finance comes up in the second half of the book, and people are tired, they're exhausted. You can't quit when it comes to finance. There are so many points here, and the fact is, if you know the definitions, they're not extraordinarily hard, but you really have to know the definitions. You have to stay up late, you have to get them, and you have to notice how many times I use the word federal or acronyms, or things that look really, really close to each other.
Yeah, I have my list of all the vocab by topic, where I've broken down each of the vocabulary, words, and I say, oh, it goes to this topic or that topic or this topic. And what I know is that when you look at the finance section, there are so many words, so many vocab words you have to know, but that's good. There may be a lot of them, but the truth is, guys, we're not going to school to become mortgage brokers and bankers. So they have to ask us stuff at a very base level, mostly based on vocab. So if you can learn the vocab, you're good to go.
I love that. That was a perfect explanation.
Okay. Let's move on to...
By the way, that list sounds like it would be an essential list to have.
Well, it would be an essential list to have. I'm actually it's included as a separate document. And then the essential lists, I think, would be like your synonyms. Like, remember we were talking about trust deed, and I said it's also known as a deed of trust, or you talked about an interest-only loan, which I know could also be called a straight loan. So your synonyms. Or like Fannie Mae is an acronym for the Federal National Mortgage Association. Also, when I talked about Fred's Corn, that's an acronym.
Perfect.
Because I said, familial status and all those other things. And gosh, those other lists of like dates and numbers. I think knowing all of your testable dates and numbers, all of your statutes and acts, and of course your math formulas. There's so many lists that we need to know for this class. And then on top of that, we have a list of vocab, and there's so many. So yes, I think it is an essential list.
Excellent.
Cool. Go for it.
Okay. A mortgage that includes both real and personal property is known as, and then notice we give you definitions here: A, an open-end mortgage; B, a blanket mortgage; C, a package mortgage; D, a jumbo mortgage.
All right. So this is another one where knowing our vocab is really helpful. So let's start with A, an open-end mortgage. You tell me, Chris, what is an open-end mortgage?
An open-end mortgage, in my mind, I have it associated with a HELOC, a home equity line of credit. And what happens with an open-end mortgage, it's a line of credit where you can borrow between zero and up to whatever the mortgage is. And then when you pay it down, you can borrow against it as well. So most of your first mortgage loans are, in fact, closed-end. They only go one way. But open-end goes up and down. So I think HELOC, home equity line of credit, doesn't sound like it applies here.
No, I don't think so either. All right, B, we got B for blanket, a blanket mortgage, which is not, Michael Jackson's child. But I can't believe he named his child Michael Blanket. But
I can't believe you still threw in that joke all these years later.
I I mean, it's just, I can't help it. But a blanket mortgage, whenever I think of a blanket mortgage, I think of like sharing a blanket with somebody and it's covering more than one person. Well, a blanket mortgage covers more than one parcel of property. When a developer is getting a loan so they can build not just one house, but multiple houses, they tend to get a blanket mortgage so that they can build one house, sell off that house and that lot, and still continue with the previous mortgage for the remaining lots. That is a blanket mortgage, and that is not what this question is asking, so I'm going to eliminate B.
On the blanket mortgage as a piece of extra homework, relate that to a release deed. Oftentimes when there are several mortgages under, or a one mortgage that covers several properties, when the developer sells one, it has to be released through a release deed, going back to your deeds.
Look at you all fancy pants with it. What do we think of C?
Oh man, I like C. Package mortgage, and at the end of the day, real and personal property, that sounds like a package. If you're buying a piece of beach property and it was furnished, it may be a package mortgage that you would use.
Yeah, because you might get like the beach condo. It has a beach theme. You don't want that stuff in your mountain house, so you might buy the condo and the furniture. When I think of package mortgages, I always think of Christmas gifts.
Of course.
Because. So, okay, we like C, but let's check out D, a jumbo mortgage. Well, jumbo mortgages are a thing, but a jumbo mortgage is one that is going to go outside of Fannie Mae's requirements. Remember we were just talking about Fannie Mae and the secondary mortgage market? There's limits to how big mortgage can be that they purchase. So if it's beyond that amount, we call that a jumbo mortgage, and that is not what this question is asking us about. So it sounds like to me the answer has to be what, Chris?
I'm sticking with C on this one.
I'm going to stick with you on that one as well. And it is C, a package mortgage.
And when you feel like you've studied enough or you can't figure another way to study for the exam, practice writing test questions, because when you looked at this question, this is exactly the way they write test questions. They give you a definition and then they give you things that could in fact be possibilities.
They're similar.
Yeah.
And I heard the test people once say they're looking for answers that are plausible
yep.
but not necessarily correct. All right, last one, number 10. I can't believe we're flying through these. Here we go. What does the loan-to-value ratio, or LTV, represent? Is it A, the ratio of the loan amount to the borrower's income? Is it B, the ratio of the loan amount to the appraised property value? Is it C, the interest rate compared to the annual percentage rate? Or is it D, the loan term in comparison to the borrower's credit score?
I have a problem with all of these answers, but I'm not going to fight the test. I'm not going to fight the test.
And that's what we're not going to do.
Right. I'm going to just eliminate. Okay. So I'm going to eliminate A, the ratio of the loan amount to the borrower's income. Now, the reason I'm doing that is you see the loan amount in there. There's the L, but it's the LTV, the loan to value. The borrower's income technically has nothing to do with value.
All right, I got you. And that makes sense because there are ratios that we talk about with your income, but that's like our 28, 36, our debt to income ratios.
Perfect.
Also a ratio, but not the one we're looking for. Well, we have B, the ratio of the loan amount to the appraised property value. Now, I do like this one, but I also dislike it, because it's got the magic words, LTV, loan to value, and it says the ratio of the loan amount to the appraised property value. So it's got some key words. I love that, but I also know that sometimes it's not the appraised value. Sometimes it's going to be the sales price if it appraises for higher than the sales price. So I don't really love it, but let's move on to C. Maybe there's a better answer.
Yeah, I'm putting a star beside that one, but I'm not convinced yet. So C, the interest rate compared to the annual percentage rate. You know what? Again, important words, interest rate and annual percentage rate, both important concepts that you should understand. They just don't have anything to do with this question.
Yeah. And then we got D, the loan term in comparison to the borrower's credit score. Really good, important words, long term. How long is the loan going to last for? And then the borrower's credit score, also important, but definitely what we're not talking about, which brings us back to B. And what happens, Chris, if we don't love this answer of B?
Well, it's an imperfect answer, but it's better than all the other ones that we have seen.
There you go. You don't have to agree that the answer you choose is the best answer. It's the best out of the options they gave you. So we're going to go with B because that's all we really got. We eliminated A, C, and D, and B is what they wanted. So what do you think, Chris? Was this helpful?
I enjoyed talking around these terms. It's always fun because every time you talk about a word or a concept, something else comes back. And when Candace was talking earlier about some of her essential lists and things, it's all about connections. Do you know what it goes with? And if you know what it goes with, do you know the distinctions?
I like to say, remember this, guys. For me, I think the test has two levels of questions. You have the recall and recognition questions, which are just, hey, do you know what this word means? Do you know it at a very surface level? And then you have application and analysis. Can you identify scenarios or situations in which this might pop up or how you would respond to something? You got to have the base knowledge, but once you have the base knowledge, how does it apply to a situation? So knowing what type of question or knowing your information at a application and analysis level is only going to help you at the end. Because if you know it at that level and they only ask you to recognize it, you're good. But if they do ask you to apply it, you're also good. Everything is connected. If you think of one word and you can associate 4 other words and how they relate, you're doing good.
Excellent. Yeah, I like that comparison. And look at you breaking out your triangle of learning levels.
I do have a triangle of learning levels. I like it. All right, guys. So there you go. We really hope this helps. We love breaking down these questions with you, and we'll see you next time. Bye.
Bye.